Good afternoon, everyone. Welcome to our December 2023 monthly market exchange. We thank you for joining us today. This is Jeff Hibbeler along with Randy Farina. Before we get started, I'd like to remind everyone to please send in any questions or comments to info@essentialwealth.com. We will do our best to address these toward the end of today's call. So a week ago today, Charlie Munger, the vice chair of Berkshire Hathaway, passed away just a few weeks before his 100th birthday. Munger wasn't as well known as Berkshire's chairman, Warren Buffett, but he was a legendary investor himself. And one of his credits is helping shift Berkshire's investing focus from buying a fair business at a good price to buying good businesses at fair prices. The philosophy of buying a good business at a fair price resonates with me, as has some of Munger's other quips. One of those quotations that I feel like I can share on today's call is, knowing what you don't know is more useful than being brilliant. Munger was probably a brilliant person in his own right, but there is a particular insight into assessing what one doesn't know. This can be particularly the case in the investment world, where having the discipline to stay away from investments or companies in which a person doesn't fully understand the risks, which I believe would lead to better investment outcomes in many cases. Randy, good afternoon. One thing that I do know is that markets have been doing quite well and has put in some strong performance since our last call. The S&P's continued its rally and it's trading near year-to-date highs, while the bond market, it's also been rallying, and the 10-year's fallen close to 50 basis points to around 4.2% today. It's been quite a year in the equity market, so I thought I'd turn it over to you for your perspectives on it.
Sure. I thought you were going to say one thing you're certain of is that I'm not brilliant. I'm glad you didn't go there. So,
No,
yeah,
not at all.
And I was at Putnam for 20 years, and a lot of people, I'm sure, have read the Buffett's, annual reports. Is even a book that contains a lot of the narratives and discussion points from his annual reports. That is forms a very good basis of an investment philosophy framework. I've run across many PMs who say, we're like Buffett. We try to be like Buffett. So everybody is trying to, copy, and that's a form of flattery, of course. One thing about shiny or try to avoid things that are working at the moment that may not have underlying value. There's a human emotion that is always present in investing, and I think the best, if you can control it, the better the results. It's best to try to be unemotional, but it's impossible. So you try to limit your decisions, you're limiting your decisions, you're limiting your emotional reaction to the stocks that are up, the stocks that are down. Let's contrast this year and last year. December 20th of last year was around the low of the market. Here we are early January, and the markets are now at a high. I would think that a lot of people feel much better about themselves a year later than they did last year. Just their accounts are probably more normal in their eyes, or back up above where they were leaving 2021. So again, that is an emotional reaction that, as a investor, trying to pick stocks and weight different sectors and overweights and underweights and trying to outperform on an annual or long-term basis, we try to control our emotions. So it's essential, and we discussed this repeatedly. We have a process we're trying to use, where we view long-term cash flows as the driver of stock prices. Stock prices can get overvalued and undervalued in any one period of time based on multiple factors that sometimes it's hard to discern what's driving the market, what's driving a sector. But from my vantage point, over the long term, if a company is able to grow its cash flows, and be good stewards of capital, no dumb acquisitions, good corporate citizens as well. The market will reward those companies, and you can kind of use that as your philosophy of how to generate alpha over the long run. Is just buy good businesses at, as Buffett said, good businesses at decent pricing, and let compounding of interest work in your favor, the compounding of returns over time. So again, a lot of what they do, Buffett and Munger, has been used in other people's philosophy, and we also try to think about things on the long term and buying good businesses. But once in a while, we run a value strategy, so some of those businesses may not be great businesses, but they may be good prices, and those are what we call more trades rather than long-term holds like we would have in some of our other strategies. So 2023 started the year, the market went up and it stayed up most of the year. The only wrinkle, and this is where you'll come in, Jeff, and talk about the March bank failures. That was really the only significant shock to the system, and that seemed to get handled very well, very quickly, and the market moved on. I mean, I was asking Jeff this morning just to remind myself what happened in March of 23 on the SVIB bank and the Signature Bank, I think was the other one in New York. So the market moved on very quickly because that was contained, and I thought the Fed did a good job creating some programs to help banks have a place to go to minimize some of the rapid rate rises that were impacting the value and the accounting of some of the securities that they held. That was really it. The theme for 2023 was everyone was waiting for a recession that never came. Employment stayed strong. GDP growth was strong in some quarters, stronger in other quarters. The consumer continues to spend. There's been a few bumpy months here and there in the market, but in general, it's been a good year. I think we all know the S&P is up almost 20% or over 20%, and it's being driven by a handful of companies. If you kind of look at the equally weighted S&P, it's up only 8. If you look at emerging markets, they're up 5. International's up about 12. Value and small caps are up about 6 to 8. So almost most of the market is up anywhere around 8%, and then the S&P is up 20. And again, the S&P has been really driven by a handful of stocks this year, the Magnificent Seven, and a lot of that is they were poor performers in 2022, and they've also grown cash flows and revenues and never hit the recession and profits that most people were thinking was going to come in 22 that drove those stocks down. And some of it is multiple expansion with the AI theme as well. So in general, good year. Everybody feels good. The markets certainly aren't out of the woods of any potential troubles. There's still potentially a slowdown, whether it's a recession or not. Rates continue to be a bit volatile. The 10-year went from 5% from the summer of, it was around 4%, jumped to 5% in the span of a couple of months, and now it's back down to almost 4, and I'm referencing the 10-year for that. So that there's been bond volatility, and Jeff will get into why and how, but that's also a potential for some equity volatility as well as we look into 2024. I'll stop there. I haven't really talked much about 2024, but Jeff, I'll throw it over to you just to give a kind of a review on fixed income of 2023, and then I'll go kind of sector by sector for my outlook for 2024.
Yeah, thank you, Randy. As you pointed out, clearly the bond market has had probably higher amount of volatility than average in a particular year. Coming in, we felt the Fed was going to be the big driver, and it was, of course. But given that it went from an aggressive tightening pace in 2022 to more of an kind of an incremental phase of their hiking cycle. So far they've hiked by 100 basis points, and we really feel that they're not going to hike at the next meeting here next Wednesday. So now they're in taking an approach that is cautious and patient, now that they feel like that they have policy well into restrictive territory and letting it work. Randy, as you pointed out, the 10-year hit 5% for a short time. Coming into the year, the fixed income team would have thought that was kind of an unlikely scenario. But what we saw is that the market was driven by sensitivity this summer to the Treasury deficit and auction forecasts. That's something we haven't seen in quite a very long time, and we don't think that at this point it's a dynamic that's going to be going away, but instead that the importance of it and the importance of auctions and that to the market is going to be driven by the economic backdrop. And what I mean by that is in a kind of the summer when we saw the talk of essentially a no landing of the economy, that it would just kind of keep roaring, was probably at its peak at that point. And so the market was more sensitive to that increase in supply and the resultant impact in yields. Contrast that with now, at this point, we've seen a little bit of a cooling in data. The Feds maybe shift their focus a little bit to the financial conditions, which I'll talk about a little bit later. But the market is more willing to absorb that supply, and so that backdrop does tend to influence how the auctions go and the resulting impact on yields. So as I mentioned, we have started to see somewhat of a cooling. Clearly third quarter GDP came in really at a breakneck pace, basically 5%. And if you look at nominal GDP, which includes inflation at it, it was basically at 9% annualized for the quarter, which is very strong. But we are seeing some cooling in the data, particularly in the manufacturing and goods sectors. That's been kind of going along under the surface for a little while. But now in the employment market has started to, it's still growing at a pretty reasonable pace, and we get another update on that this Friday. But it is coming down from its prior stronger growth. And then, of course, importantly, inflation has continued its downward trajectory. It's still, well above the Fed's target, but it's moving in the right direction for them. So kind of overall, the economy and inflation are still above the trend type levels that the Fed and most economic, pundits forecast. So there's still more work to be done on the monetary policy side. But as we, looking at the economy overall and kind of coming in, we felt that Fed tightening with its lags would start to have impacts. We're starting to see that, and then that is over time what's supportive of the fixed income market. It kind of, at that point, yield increases can be self-limiting as it affects and slows down economic growth. So we've seen that come through here in the last, roughly month or so, with the sharp move lower in yields. So that's kind of where we're at. And Randy, I'll kick it over to you, back to you for kind of your 2024 preview. And appreciate you bringing up the Mag 7. That's definitely been one of the bigger themes in the market this year. And kind of like, I don't know if you want to elaborate any more on, you discussed the good businesses at fair prices, but that certainly does, kind of affect how we've been viewing some of that with sectors as well.
Yeah, sure. And again, I'm not here to give any 2024 outlook every year is, who knows what's going to happen. All we can kind of give is our thoughts. So don't hold me to any of my forecasts for the following 1 year, because I honestly don't know. There's a lot of headwinds and potentially in the economy, but there is also things that the Fed has done. It's hard to, you can always be critical of the Fed, everybody is, but so far they raised rates to hopefully slow the economy, which they really haven't. And some of that's just the post-COVID adjustment. This is not a normal cycle either. There's a lot of extenuating circumstances that are making this non-normal, and COVID is 90% of that. It wrecked supply chains. It pulled forward demand for home and improvements and automotives, and it ruined the normal cycle of businesses and inventories, and even consumer spending patterns. People spent on a lot of goods, and then they spent on a lot of services, and so all that's still normalizing, and that's taking time to work through the economy, to work through all the data that the Fed uses. So again, as you judge the Fed, slow to react, then reacted very rapidly with 475 basis point hikes, I believe, or at least 50, 4 or 5 of them, and now is in the wait and see mode. And inflation has rolled over. And what is inflation rolling over means the rate of change has slowed significantly. So, we all know goods are more expensive. You go out and fill your laundry basket, your shopping basket, and it's definitely more expensive. Everything is more expensive. And that isn't going to decline. What's going to happen from here is that rate of increase should be back to more of the normal, call it 2 to 3%. And that's where the Fed has been targeting, and that is why they raised rates so fast, is because that initial burst in 2022 coincided with the war and all the supply chain stuff of 10% inflation hikes it was unacceptable, and they needed to react. So again, it's not judging them as mission accomplished yet, but they've been able to thread the needle so far, and we have no idea if they'll be able to continue to do that in 2024. But so far, so good. And very few people want to give the Fed credit for anything, because the Fed bashing is just a natural pastime of being an investor in the public markets. But again, so far, so good. And that's how I'd explain, or that's how I would forecast the economy. And that's kind of the outlook for 2024. Certain sectors are more attractive than others, as Jess just mentioned. The Magnificent Seven: Apple, Microsoft, Nvidia, Google, Amazon, etc. We own most of those. They are great businesses. Some of them are good businesses, and some of the prices just aren't reasonable, or they're just expensive. And so what does an expensive stock means? It means the future returns will be lower. It doesn't mean that it's no longer a good business. It's just not an ideal potentially investment opportunity at the moment. Doesn't mean it's going to decline 20 or 30%. It's just, it may do nothing for a couple of years, or even, I've talked about this on the calls before, when you get expensive markets like in late 99 and 2000, when stocks were at 100 times earnings, Cisco, Microsoft, Amazon back in the day then, they took 15 to 20 years to get back to that price that they were at in 99. In fact, Cisco is still below its 1999 price. Microsoft took 15 years to recover. Qualcomm took 17 years. I know I've given this information before, but again, as Buffett says and Munger says, buy a great business at a reasonable price. You want to make sure it's a reasonable price. That's why we do all the valuation work. That's why we have a cash flow based model that's based off forward looking inputs for growth rates, margins, capital intensity, and some element of a discount rate that helps us discount those cash flows back. So again, certain sectors today more attractive than others. Where we're seeing value is in from an asset allocation standpoint, small, emerging, international, value, those are our asset classes. Small caps, not small value emerging markets. I mean, small caps in general, US small caps, international large caps, emerging markets in general, and value stocks in general seem to be more attractive than the S&P 500 today, given that concentration. But then within sectors, there's attractiveness in staples and healthcare. Those got hit in 2023 because of the weight loss drug Ozempic. That has shaken up the potential for long run, sales, or the total available market, or the market growth for beverages, sweets, snacks, and then even healthcare procedures. Because the thought is, if everyone is in, I think I've mentioned this before on prior calls too, if everyone is in better shape because of this wonder drug, then there'll be less health procedures. There's a less of a desire to eat snacky foods. And that's what that was the impact to the stocks, was that is going to happen. And my opinion is it's way too early to know if that's going to actually pan out. And to me, the actual impact will be so minimal that you're not even going to see it. But the stocks react, knee-jerk stocks, inefficient, short-term. That's why we all have jobs, more efficient over the long term. So I do think that narrative of that drug and the impact of the staples and the healthcare have created an opportunity this year. I think that AI, I just don't find the names that are a proxy for AI as attractive at the moment. I think we can find, and that's mostly AMD and NVIDIA in the semiconductor space. We have other semiconductors names that will benefit from longer term trends in data center buildouts, from the automotive adoption of more safety and more features in the car, and the more mix towards EV or hybrids. That helps underlying semiconductor demand. And we own a few companies that play on that, STM and XPI on semi. So that is how we're playing growth, not just through a narrative of AI. Energy is a wild card for 2024. Don't know if the wars will escalate. Don't think they will. OPEC is having to cut output because there's just, the supply demand is better than what was thought 12 to 18 months ago. So oil prices have continued to trend sideways to down, other than some shocks when the October 7th Hamas-Israeli conflict, or war, whatever you want to call it, started. That impacted the short-term oil price. Materials, I do think there's some overvalued in some steel stocks and some metal stocks. We're seeing value in more of the farm cycle related names, in the pesticide and seed companies. I think that's where we're seeing value. So again, that's just don't want to get into the weeds, but just wanted to give outlook of the markets move, but underneath the market, there's always opportunities of pockets of undervaluation, and then there's some overvaluation as well. And as investors running different strategies for Essential, some strategies don't have a lot of turnover, some strategies have more turnover, and we're trying to stay true to the mandate of the if you're buying the value strategy, we're giving you some value stocks, some stocks that are mispriced at the moment, that has much more of a higher turnover than if you're buying the core strategy, which is trying to own more compounders, more what we call decision one stocks, just winners, as long as they're at reasonable prices over time. So when you see trades for your client accounts, understanding that each strategy has a different mandate and a different strategy process behind the stocks that go into that strategy. I'll leave it there, Jeff. I kind of went on a bit too long, but I was just trying to give a perspective on the different sectors and where we're seeing value.
No, appreciate that, Randy. One thing I wanted to clarify quick, going through the kind of where we're seeing a little more value in international and value in small cap versus, say, large cap growth. But just to clarify, doesn't mean that we're looking to reduce or completely move out of, let's say, large cap growth from asset allocations. It's more of a, when rebalancing, when making adjustments at the margin, those are the, where we're seeing a little bit more value across the broad
Right.
asset
So
allocation landscape.
correct. So remember, my seat at Essential is running 5 strategies. Then the advisor works with the client. I don't know an individual client's goals, their age, their underlying plans longer term for their gifting, or their they leaving a legacy of whatever the client objectives are. That is when you work with your advisor, and the advisor has an allocation overall that weights to different asset classes, and that's a discussion with the advisor and even Tim Courtney, the CIO of the firm, how we want to move different weightings for certain areas of the market. Now, as a portfolio manager running the core strategy, if I'm seeing some value in international, small, emerging, I may sprinkle in a few of those names, but it's going to be an S&P 500 strategy that's going to own most of the names that are in the S&P 500 picking pool. And it's not going to suddenly become a small cap strategy because that's where I think there's some value. No, we're running the strategy with the benchmark in mind, in the asset class in mind that it's representing within a client's portfolio.
Perfect. Thank you, Randy. Yeah, so I'll hop into kind of the early preview for 2024, even though, at the risk of us, how much could change here in the last month of the year, right, Randy? But nonetheless, it's always good to put our thoughts out there. And as I mentioned a bit ago, the Fed is meeting here next week. They're going to 99% going to pause at that meeting, and really we think that they're likely done hiking for the rest of the cycle. Now, really, in order to kind of push back on the market pricing, at least for a time being, we think they're going to keep the possibility of a hike still out there. And some of that is just the nature of the data dependence that they're in, but it's also essentially managing market expectations. That markets tend to have kind of around a 2-quarter window for pricing current circumstances, and then it tends to want to price in the next move. And kind of what we've seen here in the last few weeks, we do think the market has gotten ahead of itself a little bit with pricing cuts as early as next spring at this point. So kind of our the background and how we're thinking about it is, the Fed's coming off a period where inflation ran significantly above its target, and inflation expectations, looking at various surveys and consumers, really were at risk of becoming unanchored. And frankly, it's still up for some debate that those expectations have been stabilized, kind of where they would be, commensurate with the Fed's 2% target. So we think that the Fed will want to maintain a restrictive policy longer than a typical cycle. And Randy, you mentioned the consumer still feeling the price increases, and that's part of the expectations, is that yes, inflation is rising at a slower rate. It's still rising, and when folks think back 3-4 years ago, as the price levels, it's in a lot of areas it's moved up pretty significantly. So with that, again, we think they're going to want to hold here probably at this kind of plateau for longer than average. If you look back to the prior cycle in 06, 07, they were on hold for a little over a year. So that's one barometer. History doesn't always repeat, but it does rhyme. So part of our basis for thinking they're going to want to stay on hold longer. And there's always the usual caveat of a shock or a large drop in equity markets, what have you, that could force the Fed into action. But with that typical caveat, we don't think that they'll want to make any rate cuts until at least the second half of next year. Again, they're highly data dependent, but they want to allow the lags of tightening to work their way through, as well as maintaining that restrictive policy to get inflation back down to their target. And given where the economy is overall, particularly the labor market, with unemployment below 4%, it's in a very strong place, and it's allowing them to take that time to let their policy work. One other thing that they've been focusing on lately are financial conditions, and a lot of that is where our long-term bond yields at. They've been placing a lot of weight on that, particularly as those yields were higher in tightening conditions. However, as I mentioned recently, yields have fallen a pretty fair amount. And I think also, if we kind of maintain around here, that's going to keep them on the longer plateau period for their Fed funds rate, as financial conditions aren't as tight as they were a couple months ago. So kind of with that backdrop and restrictive policy stance, it seems likely the economy will will cool more, continue to cool. If it doesn't, if the economy does continue to inflects back up or grows at a stronger rate, to me that reinforces the need for higher policy rates, and that would itself also push cuts further out. So I think overall, Randy, you mentioned the expected recession that hasn't come. Some say the most anticipated one ever that we haven't seen. The resilience has been surprising, I think, to many people. You outlined the wars. There's been weakness overseas in Europe and China, et cetera. It hasn't filtered through, interestingly. So it has been a very unusual cycle for a lot of reasons, but we're at that point now where the Fed feels like it can be patient and be a little more probably methodical in its policy approach, rather than the approach they had to take last year, where they wouldn't say it, but they were catching up and had to make changes very quickly.
I think Buffett would call you brilliant, Jeff.
I
would like to say one more thing, just as we're looking for 2024's outlook. The markets really, again, if you look point to point, they haven't done anything since late 21, which seems surprising because we all know they nosedived and then they've come back. But really, the S&P's flat since November of 21. That's 24 plus months. But earnings have continued to grow. So there was definitely, in hindsight, some overvaluation in 21, and rates were at suboptimal level for really long-term health of fixed income markets, and just in general of where interest rates should be at, reflective of longer term growth. They were dislocated, and now they're back to normal. Earnings have continued to grow. A lot of the COVID readjustments are running to almost completion now. That is what is healthy as we go into 2024. I think this is just my opinion. From a full cycle standpoint, we're much better today than we've been in the last couple of years. More normalized level of interest rates, more normalized supply chains, more normalized post-COVID adjustments for certain sectors. So, it's things are set up for a decent year, but you never know. You always get that, out of the blue black swan event. We had it in March of last year with the two banks going under, but that was quickly, at least blanketed it in firewall that didn't spread, and that was the risk and fear at the moment, because everybody is fearful of another 07 and 08, and we all lived through that. I ran small cap money during that time, and that market was brutal. The market was down. I think the S&P was down 30+% that year. Small caps were down almost 50, and oh wait, no one wants to see that repeat. And that was because there was a contagion within the financial system that then impacts everything. This time around, that fear was there, but the Fed was quick to blanket it back in March. So again, where we see value, we'll move the portfolios towards that, but I wouldn't expect any major changes from right now, as Pete and I are kind of doing a year-end review of all the strategies.
Yeah, something I'd follow on with what you just said, Randy, is
your brilliance.
Not my brilliance, no, okay. Not at all. But sometimes there's brilliance in the simplicity, but I guess two quick things. One, you outlined kind of the point to point, at least in equities from 2021 till now. There hasn't been a big change from that point to this point, but clearly the markets have swung around a lot in the meantime, and that's where kind of the rebalancing that's done at the asset allocation and portfolio levels, it can be additive over time by rebalancing from those maybe more expensive areas to some of the less expensive areas, which is additive. And the other quick comment I'd make, that just to touch on what you said there, is that process hasn't been easy, but the normalization in Fed policy, the normalization in rates, does get us to a healthier place where fiscal, or not necessarily fiscal, but market imbalances don't build up to the same degree, and also just the having a cost of capital and those capital decisions that market participants and people are making, they're more rational, and that's healthy for the long-term trajectory of the economy, of business formation, et cetera.
Good point. I think in 2021, 2020, a lot of, right during the midst of COVID, there was a lot of misallocation of capital to kind of businesses that will not have staying power, and got ridiculous valuations in the markets, and that was painful adjustment. Very good note about painful adjustment. The bond market normalization was painful. Rates going from 1 to 4 killed total return. It impacted bond portfolios, and that's why last year was so painful, because not only did you have the equity markets down, you had the fixed income markets down, and that was a rarity. But unfortunately, that was the reality. But now at this level of interest rates, you've, at least, as you said, you've normalized it from a market standpoint, and that should be healthier going forward.
Agree completely. So, all right, at this point, we don't have any questions, and so we'll go ahead and wrap up today's call. For our next market update in January, we're going to be having our semi-annual webinar. We're still working on the date and time of that, so once that's finalized, we will send out an email invite with that information to everyone, and hope that you can join us in January for our webinar. So everyone, thank you for joining us today, and we wish you a very happy and healthy holidays. Take care.
Thanks, everyone. Happy holidays. Stay safe.